Welcome to the Trading Counselor channel. In today's video, we're gonna go over how to structure the learning process in trading. Starting to learn about trading could be confusing or downright overwhelming, especially if you never traded before and decided to earn some extra income, and you are looking to financial markets like stocks or Forex. It might feel like trying to decipher some hieroglyphs, but it gets simpler if we structure it properly. Now, first thing you usually hear from brokers or even those who have traded before is right from the get-go to open an account. And this approach is not the best for multiple reasons. Before I get further into this, I must say that I do understand the argument that sometimes it's the best to just jump into the water and see if you can figure out how to swim yourself. And many beginner traders starting with just very small accounts, and generally, while it is not wrong to do that, be aware that shallow waters don't make you a good swimmer. And so in the beginning, before everything else, we need to set the foundation for our trading. First, we need to understand everything there is to know about the market that we want to trade on. And since we are setting up the foundation, we need to start with the jargon, or simply the words and terms that are used in a market we're targeting. Here I will use as an example Forex market. Now, the reason I have chosen a Forex market is that I have seen way too many beginner traders neglect of knowing the basics. They rush to trading and they simply don't even understand what they are dealing with. The same trend can be noticed on the cryptocurrency market. However, cryptocurrency market is a topic for another time. I will give you an example to underline the need of knowing the basics. Most commonly, there is a trader that trades anything from 6 months up to 2 years, and I ask a simple question: what is leverage? The answer is most commonly one of the two. So either they say, it is a loan that broker gives you to trade with, which is utterly wrong, of course. And in the second one is something in a line of, I know what it is, but I cannot explain it. And when I stop myself from laughing or joining the laugh with the trader, I always remember the quote from Albert Einstein when he says, if you cannot explain something simply, then you don't understand it well enough. So one more time, do learn the terminology, since we need to know in the beginning, in words, what we are working with. And further, in addition to knowing everything in words, we need to know everything in numbers. And we shall, of course, start with the values. I will be further using the example of a Forex market. And here I mean, what are the values that we have available for trading? And I mean all the values. Now, this is necessary for multiple reasons, and it will further serve us in a defining of the risk-reward ratio and a calculation of the risk management, for example. And after all of that, then is the time to have a look at the market and learn the chart. So to opening an account will be third step. The good news is the demo accounts are for free. At least most of the brokers give you access to demo trading just for simple sign up. On the demo account, we can learn things like how to place a trade, close a trade, define a risk-reward ratio per trade, and study the chart some more. And we can move to the next step, learning the analysis. Now, by learning how to analyze, we can have an answer for the most commonly asked question from literally 90% of the beginner traders. And that is, what to trade? Or what is the best instrument or the best time to trade? And the answer for this is simple. So the best instrument to trade is the one you best prepared for. So once we know how to analyze the instruments on the market we want to trade at, we have a reason to take a trading decision. In other words, we are ready to take calculated risk. In this segment, we can choose what fits the best the market we are trading at. Once again, with that example of a forex or even a stock market, we can utilize fundamental analysis, economic news or geopolitical events, also technical analysis, in which I usually like to include the statistics and psychological behaviors. What is considered the best is indeed the combination of all of the above. And for the sake of transparency, let us break it down. So the fundamental analysis will be the economical news like unemployment rate or GDP numbers, even interest rate decisions. These information are easily to be found in economic calendar, and you can find this calendar on various websites, but your broker should give you access to this for free. The geopolitical events are usually found in the global news. In recent times, the best example was of course the Brexit, divorce of EU and UK. Further, we have technical analysis, which is a study of a price movement in history. And the technical analysis are usually performed with the indicators, typically a algorithmic formula represented in the charts by various lines and price levels. These indicators are conveniently located in our trading platform, such as MetaTrader, for example. And once we know all of this, now it's the proper time to either set or reconsider our investment plan. This is another point I want to talk more at length because most traders get this for some reason wrong. The best way to double check is usually to ask, and that's why I always follow up with a question, what is the target with this investment? And usually I get the answer like, I want to double my investment. Or something like, I want to make as much as possible. And my personal favorite, with this investment of $1,000, I want to make $10,000 in 1 month. Well, I hope you see how ridiculous that sounds. Let us better discuss what is the right way of setting an investment plan. First, we need to allocate the amount. What you should allocate is such an amount of funds that you will be comfortable with losing. I know no one is comfortable with losing money, but the risk of losing money on the market is always present, and therefore we should count on it from the beginning. As you definitely heard before, prepare for the worst and hope for the best. Once we have made the allocation, we can set healthy investment target, simply by percentage or amount of money. But it has to be in a healthy proportion to the amount of money we have invested. So if I invest as little as $100, then the target of my profit will be somewhere around 20 in defined time. The overall definition of a time and the amount will depend on the instrument and the market that we trade on. Next, we need to have an actual plan how to get there. And we need to make a calculation for how many positions, in what size we need to open, and what kind of price movement we need to be targeting to get into the target in a set time with a risk mitigation. Next, we should define a set of rules that will make us consistent. Since in trading, we need to deal with the trading psychology, a consistent chatter that is changing from second to second, bringing in various ways of self-sabotage. The best way to go about this is to simply write down the set of rules you have set for yourself according to the strategy you are following. This set of rules need to be followed religiously. And we will make, of course, separate video for the trading psychology because this is a separate topic altogether. But it brings us nicely over to the last step in this video. And the last step is journaling. As a trader, you shall journal all you are doing so you can reflect and improve. If you find yourself in a place where it is not going well, you will have something to lean on that will give you answers on what are you doing wrong. Now comment down below if you can relate, because I know this is happening to many traders. You know, I have seen many traders just start trading, then losing, and they simply don't know what they are doing wrong. And yes, it is because they have never learned to self-assess. And the industry is teaching us that only professionals can self-assess the trading of another to see where was the mistake done. And that is simply because of a knowledge and experience in various strategies indeed. But as a retail trader, you don't need to have a professional level of knowledge to self-assess. Just keep a journal. The journaling is done in 2 phases. First phase is before the trading, and the second indeed after the trading is done. In the first phase, you will write down things like your investment target, your overall game plan, or simply a strategy you will be following to reach your target. Further, you will be writing down your risk management rules, your risk-reward ratio, and the rules that your strategy dictates to be following. After the trading, you enter the second phase, where you again write down all the trades that was executed, what actually was done on your account. Then the market behavior or the market movements you have experienced. And the last point will be your own behavior to the market movements. Now, among other things, this will serve us to be able to identify the unnecessary mind chatter we mentioned earlier, and thus help us to prevent self-sabotage, to help us keep the hard-earned profit. And that is it for today's video. Now, if you found this video helpful, please give it a like. And if you would like more content like this, all it takes is just to subscribe. Thank you for watching. See you in the next one.